is there enough money in the FDIC to cover accounts if there is a bail-in? Can you see how that would be a problem? But if there's a run on the banks, the public would understand that they really didn't have any money. This is a client question that is easier to answer when I show you the evidence directly from the FDIC. So Colleen Allen asks, is there enough money in the FDIC to cover accounts if there is a bail-in? If not, how many cents on the dollar would the FDIC pay on each account? Well, I don't know what they're going to pay, but let me show you from the most current DIF report. The DIF is the Deposit Insurance Fund. So what you're looking at here are the deposits by the type of institutions. And you can see that domestic deposits are over $18 trillion worth of domestic deposits. That's here. At the same time, out of that 18 trillion, roughly not quite 11 trillion are actually insured. So if you have amounts above that $250,000 level, those are not insured. So the question is, well, how much do they have? Well, let's take a look, because this is the Deposit Insurance Fund balance. And, it goes back to 22. It's pretty interesting when it goes all the way back. But as I said, you've got not quite 11 trillion in insured deposits. Well, what do they have in the DIF fund? Oh, let's say a little bit more than 150 billion. Wait a minute. As long as one bank goes out, all right, this is not so much of a problem. But if there's a run on the banks, this, my friend, is a very big problem, because in reality, according to the FDIC, they have just a little bit more than 1 penny for every insured deposit. So if there is indeed a bail-in and they honor, we're going to assume that they're actually going to honor the FDIC insurance. Can you see how that would be a problem? And unfortunately, this was before I learned about print screen. But back in 2009, 2010, when we had all those banks failing from the financial crisis, well, what did they say? They said that if even one more small bank had failed, then we, the public, would understand that they really didn't have any money. So the goal is to prevent a bank run, because then you're going to discover the emperor has no clothes. And that could be a major problem for them, because we could see the level of bank failures that happened after the financial crisis in 2008. But guess what? We are now having more bank failures today than we did before, shortly before the crisis. So what is this going to look like? And when do you want to know that the emperor has no clothes? And this is one of the reasons why I'm telling you that you need to be pulling out part of the first part, that liquidity part of the strategy involves cash outside of your bank. Because if the bank shuts it down, there's not anything that you can do. And those bank failures, well, they're right around the corner, aren't they? Because we've got so many issues that are going on. It's a whole litany, which is typically what happens before a crisis. But what you're looking at here is the simple fact that yet still banks are underwater. Remember how this works. This is interest rates. This is the market value of the debt. And the debt is anything from bonds to mortgages to credit cards to car loans to student loans, on and on and on. Somebody takes out debt. Well, if these are interest rates, when interest rates go up, the market value of that debt goes down. And that's what you're looking at on this chart, that if these banks are forced to sell this debt, they're gonna lose a whole lot of money. So they have it held to maturity so they don't have to report it. But you're looking at the DIF report. You're looking at what the FDIC is showing in underwater assets, all that debt from banks. If there's a lot of run, okay, they can handle one or they can handle the other. But if the banks are forced to start liquidating this debt at losses, what does that do to the confidence level? What does that do to the markets? Well, what it actually does is it pushes the interest rates more and the market value of that debt down even more in a self-fulfilling doom loop, a collateral doom loop. This is the collateral. And most of it is underwater from 15 years of ZIRP, zero interest rate policy. Are you going to get caught up in this? Because in order to make things look like, I had somebody on the live the other day that said, well, the British pound is still working and the US dollar is still working for some. But how about for the public? Because what you're looking at here is what I show you all the time. My very favorite chart, if I only had one. And that's the purchasing power of the consumer dollar. But my God, look at how much purchasing power we've lost since the financial crisis in 2008, which I tell you right now, that's when the system died. Not one doubt in my mind. We're going to zero. Period. And the only reason why we're not there now, the only reason why somebody would even question that is because the public still has some level of trust in the currency and in the system. And why not? People have a tendency to marry the legal money of the state, even as it goes to nothing, as witnessed by my $10 trillion Zimbabwe note or my $20 bill. That used to be enough for me to feed my family for about a week and a half. And now, what does it buy you? Absolutely nothing. And that, my friends, is by design. Inflation is not a monetary phenomenon. It is a fiat money phenomenon. And what's the reaction to gold and silver? Now, we want to look at the spot markets, and what do most people do? They just refer to it as gold or silver, but they're not. They're contracts. They're spot contracts. So what you're looking at is the trading mechanism. You are not really looking at the true value of an ounce of gold or an ounce of silver. That's the fundamental value, and that's where it's headed. When it's time to regain the confidence of the public, that is exactly what happens 100% of the time. 100% of the time, there will be a component of gold put back in the currency. Look at Zimbabwe. Well, you can't have access to it. That's why the gold must be redeemable, or you don't know if it's really there and it's just another lie. It is another lie. You want to know what the truth is? Physical gold and physical silver. That's your savings. That's your protection. This stuff, it is simply a tool of barter and a tool of risk transfer and a tool of wealth transfer. Yep, we got to have it. It's our tool of barter. And I can tell you, I have more in the bank than I'd like to have because I'm running a business, but I also have it properly diversified so that if that goes away, I have my gold and silver to recoup those losses. And it's not if that goes away, when that goes away completely, because we are on the verge of it. And what's going to gauge it is that confidence level. But rapid inflation erodes that. And look, I could be wrong. However, I believe with every fiber of my being that when that confidence level breaks below the lowest level that it's ever been at, that's when the clock starts ticking. So let's come together, local community, to create that surety. If your bank account says no, you need to make sure that you can still eat and feed your family. So food, water, security, energy, barterability, wealth preservation, community, and shelter. Get it done. And that's on a local basis. On a global basis, Let's take away their power. My God, why should they have that power over you? Why is that okay with you? Why is it okay for you to work for corporate flipping debt? It's disgusting to me. Absolutely disgusting. Let's make that change. Let's get redeemable gold back in the system again. Let's take our power back. Citizens for sound money. We can do it. I'm a citizen and I am all for sound money. How about you? And until next we meet, please be safe out there. Bye-bye.